one of the operators we work with, they go in, they buy mom and pop owned and operated self-storage and mobile home parks. They'll buy them quickly for cash, and then they'll upgrade them and they'll increase the income, and then they'll go out and they'll get, let's say, 45% or 50% debt on these, which honestly gives a lot of capital back to redeploy into other assets. And it's a really good play. If you have cash available right now and you can buy for cash, or if you can get owner financing on mom and pop facilities, that's a good play right now.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 414. We're hearing a lot in the media about impending doom in the commercial real estate market. Should we be bracing ourselves for a repeat of 2008 and 2009? You might have seen Paul Moore's recent BiggerPockets article titled, "What's Really Behind the Slew of Recent Commercial Failures?" in which he urges us not to overgeneralize the term commercial real estate and instead recognize that there are many asset classes in many locations, and many of them will be just fine. I've invited Paul back to the show to share his perspective on whether we should be bracing ourselves for a commercial real estate crash. Paul is the founder and managing partner of Wellings Capital, and he's also a best-selling author on multifamily and self-storage investing. Paul, welcome back to the show.
Brian, it's great to be here again. Thanks for having me back.
Always a pleasure. And like I told you many times, you have a standing invitation to come back on the show anytime you want, because you always bring such great value. And I knew that when I saw that article in BiggerPockets, that this would be the perfect opportunity to have you come back and kind of explain to us what's going on out there in commercial real estate.
Well, it's great to be here. I hope I can fulfill your expectations, my friend, because I am, you're one of the first podcasts I was ever on 7 or 8 years ago, and it's such an honor to be here again.
Yeah, and right back at you. You had an excellent podcast called How to Lose Money, and I had a fun time being on your show as well. And you really had some great topics on that show.
Yeah, we had a lot of fun doing that for 4 years. We got tired.
Anyway, tell us what's going on. I mean, you wrote this great article, kind of set the stage for our listeners. I mean, those who might not be aware of where this distress is coming from in the commercial real estate market. And I know it's coming from different directions, but just kind of put it in context for us. What's going on out there?
A lot of the distress we're hearing about right now, there was an article. Let me see if I can find it here. It was the biggest crash imaginable is coming for commercial real estate assets. Wow. When I read that, I got scared. And then I opened the article and I read it. And I'm not saying it was clickbait. Don't shout me down, my friends at BiggerPockets, but I will tell you that whole article and every single word of the article was about office. And then it referenced different sources. And I think it was 2 sources. And both of those articles and statistics were about office. And so now that doesn't let everybody else off the hook, but let's just look at office for a minute. It's had a fundamental shift, and we all know this, with a decrease in demand since COVID. I mean, I looked at the statistics a few minutes ago. Let me see if I have them here. There's a huge percentage of employees who can now work remotely. I think it's all but 42% can work remotely now. And so either part-time or full-time. And that doesn't mean they will. I mean, people are realizing the benefits of being together in an office, and maybe it'll bounce back. But you know what? I'm not going to invest in office right now. I know Buffett and a lot of people you and I both really admire invest in things when they're really down, but that's too much risk for me. So for office, for example, I mean, that is a perfect example of overgeneralizing.
How bad do you think it's going to get? Like, what are you reading? What are you seeing out there as far as office is concerned? Is there going to be the biggest crash imaginable?
A lot of it can be repurposed. And, it's really hard to repurpose office as self-storage because the floors aren't really load-bearing enough in some cases. It's hard to repurpose it as multifamily because there might only be one restroom in a 10,000 square foot floor, whereas they need a ton of plumbing for kitchens and bathrooms in multifamily. And so it's really hard to repurpose from what I've been told. But I really do think it will be an extremely speculative investment. And I really don't know, Brian. I just don't know how bad it's going to get. I mean, it's easier to see the future of multifamily, single family, mobile home parks, office. It's just really a crapshoot in my mind.
Yeah, I think the kind of the impending doom in the office market is just the loans that are out there that are renewing, and the lenders are saying, we're not going to renew your loan.
Yeah. Or unless it's already been foreclosed on, and there's a whole bunch of that out there. That's for sure.
A lot of the commercial real estate, you're right. When I see these articles, everything's getting lumped in with office, and there couldn't be a bigger difference between office and multifamily or self-storage. So let's kind of go through the different asset classes like you did in your article. What's going on in multifamily? Because there is distress in multifamily, but it's a very particular type of distress that's happening right now.
Absolutely. So when I came on your show originally, I had just put out my book about a month or two before called The Perfect Investment. And then I went on about a year and a half or two after that. I began to go on every show I could and write a lot of blogs in BiggerPockets saying, time out. The perfect investment's not perfect if you have to overpay for it, if you have to over leverage, if you have to assume rents will, trees will grow to the sky, the rents will grow forever. If you have to assume that, did I mention floating rate debt already? If you have to use floating rate debt. And so I'm not saying any of those in themselves are, particularly evil. People made millions and millions of dollars with those assumptions during the last decade until they didn't, because the last year and a half, obviously I don't have to even say what we saw with interest rates just going almost due north. But what that caused is, first of all, we've seen rents actually decrease, not only slow down, not only level off, but in some cases decrease. And so, for example, Tides Equities in Dallas, they were in the headlines yesterday in The Real Deal. As we record this in mid-November, they were in the headlines again. These young guys who were superstars just a year and a month ago. I saw articles saying these were the future superstars of multifamily. They had grown, these really young guys, to something like at 33 years old, something like that. They had grown a portfolio of like 6 or 7 billion of multifamily. And the next thing I know, 3 months later, they're in the headlines of The Real Deal or somewhere again saying they're in big trouble. And they're in real big trouble. And they're not alone. There's a whole lot of others. And one of the reasons is the lack of rent growth they projected. Number two, sometimes, I'm not talking about Tides anymore because I have no idea about them. But some podcasters, what am I saying? Some syndicators actually built in, they overraised, and they overraised to do, value adds, to do other stuff, to have reserves, but they sometimes use those to pay distributions. And if they overraise, that actually watered down the future if the future didn't go as well as they thought. What I didn't expect in all those articles and all those podcasts was something I actually didn't know. And that is folks who are buying rate caps on floating rate debt actually had to reserve money to pay for the renewal on the rate cap, or the new rate cap they'd have to buy at the end of the first one. And so some of these guys, the lender would come in and say, hey, your deal doesn't work without a rate cap, and you're going to have to buy a new rate cap in a year. And so they were putting $1,000 a month. One guy was putting $1,000 a month aside for his new rate cap. And the lender said, we're mandating that you increase that from $1,000 a month to $89,000 a month. 89-fold increase. And another guy on that same phone call goes, yeah, I was paying $2,000 a month into my reserve. They increased mine to $70,000 a month. And by the way, both of those, are wonderful people, wonderful syndicators that made their investors tens of millions of dollars over the last decade. But they got in trouble. So, both of them had to pause distributions. And in some cases, who knows, they might even have to do a capital call to, just to keep the asset afloat, just to pay for their new rate cap, just to, avoid foreclosure. So that's one of the huge things that's happening in multifamily right now. I was on a call yesterday, Brian, with one of my investors who really liked us. And she said, oh, I just came up, I just saved up $50,000 more to invest in your next fund. I think she's invested with us twice. And she said, but now I'm nervous because 6 out of 6 of my multifamily investments with another syndicator, every one of the 6 has paused distributions. And now I'm wondering if they're going to do capital calls. If they do, I wonder if I'll need this cash to be ready for the capital call. And so, and that, if you think about that, that's, I was the secondary, our fund, if you want to call it that, was a sort of a secondary victim of someone else's, issue. I don't want to say mistake, but I think it was a mistake. But anyway, the operator, allowed this to happen because they got floating rate debt. They got caught with this huge rate spike. And now they had to pause distributions. They might have a capital call, and now other investments aren't being done. So you can see how this ripples through the economy.
I want to make sure our listeners are tracking, because you brought up some key terms that I want to make sure makes sense. And let's start with capital call, because that's basically when there's a shortage of money in the investment, and all of the investors have to pitch in to make up that money. So it's basically the sponsor of the deal calling up the investors and saying, hey, we need you to put in, you invested 100,000, we need you to put in another, 18,000 or whatever. That's a capital call.
That's a capital call.
Yeah. And then you were talking about purchasing caps on the interest rate. And that's basically for those in the past couple of years who used floating rate debt. So they had a very low interest rate, but it was floating without, there's basically a cap is sort of an insurance policy that you can purchase to prevent that rate from climbing too high. So if rates more than double, you're still capped low because you purchased this cap. But the problem is you have to keep purchasing that cap every year, and you have to escrow for it. So that's where it's not that these sponsors and syndicators got in trouble because they had floating rate debt that got more expensive. It's the caps that they had to purchase and put escrow money toward that got way more expensive.
Yeah, that's right. That's absolutely right. And that, like I said, in all those years, I was warning people about floating rate debt and overpaying. I did not even think about that issue because I've never used floating rate debt except in my personal, home equity line. So.
Yeah. I mean, it was great while rates were low because the whole point of having the floating rate debt was you could have really low interest rate and it could go lower if rates went lower, which they did quite often. And then B, when it came time to pull money out and refinance, there weren't any prepayment penalties. So a lot of people were able to avoid prepayment penalties by having what's called a bridge loan. And that worked great for years. But then until it didn't work great anymore.
Yeah, right. I mean, one of the reasons people were so successful, making so much money in a short period of time for their investors, let's say from 2018 to 2022, just as an example, was there wasn't defeasance. There were not early, loan payoff penalties. And because there was no defeasance, they were able to, because this floating rate debt had no defeasance, they were able to cash out and save what would have been millions and millions of dollars paid to a lender is now went into the investors' pockets. And so that was a great time while it lasted. A friend of mine was telling me that 90+% of the time, floating rate debt works out better than fixed rate debt. But we're in one of those periods right now where it's really bitten hundreds or maybe thousands of syndicators and, tens or hundreds of thousands or more of investors.
This is not just one or two people made a big mistake. It is a whole group of investors who find themselves in the same situation. Paul, you talk about the book you wrote, and apartments were the greatest investment unless you had to overpay and all that. I stopped investing in apartments in 2015 because I just couldn't justify the price. I was spoiled from a great recession when I was buying at pennies on the dollar, but I just couldn't justify paying for future value after I had to buy the property, go in, spend more money to add value, and then I was paying on that value. Like, that never made sense to me.
You stopped in 2015, and if I'm not mistaken, Sam Zell stopped that same year, if I'm not mistaken, in buying multifamily. What was it like? I know you're the interviewer, but I have to ask, what was it like buying for pennies on the dollars in the, in the 2007 to 12 range?
It was not as easy as you would think because the banks weren't lending. It was very hard to find the money. I didn't know how to syndicate or raise private money at that time. So it was a lot of my own money, investing with my family. Still looking at properties that were distressed, that even though I was able to buy them at a super low price, and I wish I'd bought every single thing I'd looked at during that period, a lot of them still didn't pencil out. So it wasn't like being a kid in a candy store. It was still a very conservative time, but there was a lot more opportunity and options because it was a buyer's market.
Yeah. Second question, do you think that'll happen again?
No, because I think the cat is out of the bag. Everyone knows the value of multifamily, and we'll have ups and downs, but I think a lot more people understand the true value and fundamentals of multifamily. And there's a lot of money waiting to come in and take advantage of any distress. And I think that's going to prop up the market.
Right. Makes a ton of sense. I agree. The supply and demand right now is so out of whack, and it's getting worse as we speak for a number of reasons. So I do think that demand is going to make it very, very hard for the average syndicator or investor to get in on this.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
It strikes me that it's kind of your fault because you wrote the book on why you should invest in multifamily. Yeah, people like you write these books, and then everybody reads them and takes them seriously.
I know. It's really true. There's a whole cadre, is that a word? Cadre of people out there who have done, courses and masterminds and guru weekends and all these things about how to buy multifamily. And that's one of the reasons we expanded into self-storage, mobile home parks, and RV parks years ago, because we saw how overheated multifamily had gotten.
Two things before we move into those asset classes. You mentioned rents going down, and that I've seen a lot of headlines about that too. Rents are decreasing now. And it's kind of like that, the article headlines that say, oh, or commercial property is all crashing. It's only true in certain areas. I think there's 20 major markets where there's been a lot of oversupply and overbuilding. Those are the markets where there's a lot more competition and you see rents coming down. Now, I invest in the Midwest, Michigan in particular, Grand Rapids, and I'm still seeing rent increases across the board on all of my properties because there just isn't enough supply.
Yeah, I would love to talk to you more about Grand Rapids offline. Remind me of that. But yeah, I agree. Just like I said in that article, self-storage is overbuilt. Is that really true? Well, let's put it this way. Maybe it's true in certain, suburbs of Detroit or Nashville or Charlotte, and maybe it's just way overbuilt. But is it overbuilt in Ishpeming, Michigan? I doubt it. In fact, we have an investment. We're the largest investor in a huge self-storage facility in Ishpeming, Michigan, and it's absolutely crushing it. And so, it's not right to overgeneralize.
Absolutely. Yeah. Is it overbuilt? Yeah. In certain areas, yeah, definitely overbuilt, but in other areas, it's not. And then the great thing about self-storage is you can just look at the amount of square foot available per person in a 5-mile radius, a 10-mile radius, and you can get some pretty good metrics on whether or not you should build or buy there.
Right. Yeah, it's so true.
And I interrupted you. I'm going back like 5 minutes. I interrupted you because you were going to give us another example of some of the distress you saw. So I want, if you don't mind going back to that moment, and then we'll move on to the other asset classes.
Yeah, another example of, I mentioned the secondary impact it had on us. Somebody did invest with us because of capital call potential with another syndicator. Another worse example was a multifamily syndicator in Texas was doing just fine. The assets going great. And I mentioned in the article, by the way, these assets aren't distressed. The deals are distressed. In other words, often the assets are doing fine. I mean, if they were all cash owned, they wouldn't be a problem, right? But at any rate, this syndicator has some fine assets, and the bank came to them some time ago, probably a year ago, and said, we're not going to renew the loan. And he's like, what? Why? And they're like, well, because we have so much distress. We have so many distressed office assets as a result of COVID that we're going to slow down our lending for everything. And we're not going to renew the loan as he expected. And so that caused him some problems. And that was a secondary impact that happened to him and his investors.
That's a shame. There's a lot of ripple effects that you don't know where they're going to come from. And a lot of it you're seeing on the lending side. There's a lot less lending, especially in the construction world. And obviously in the office world, if you're trying to get a loan on an office building, that's got to be tough right now.
I can't imagine.
Yeah.
I saw somebody on Twitter just about an hour ago. They said, I was able to raise 25% equity easily. It's I think he said 40 or 50 times harder to try to get a 75% LTV loan. In fact, he said he dropped his expectation to 50% LTV, if I read it right, and he still can't get a bank to come around.
That's really tough. So it creates opportunity for other types of lenders. I'm seeing a lot of, kind of alternative lenders out there, but you never know what you're getting when you talk with them. I'm sure that's a whole different podcast episode. But let's talk about the other asset classes, because you brought up like mobile home park, self-storage. What are you seeing as far as distress in those classes?
So in self-storage, I am not seeing much distress. I'm not saying there isn't any and there won't be any, certainly not saying that. But I am saying that I really think that, it's very hyper local, as self-storage always is. I mean, people typically don't want to drive more than 5 miles to store their stuff. And so there might be one, I'm thinking of Nashville. I drove around Nashville once, it was years ago, 2019, maybe 18. And I noticed everything looked overbuilt. But then I went to one section on the south side of town. It was either Belleville or Bellevue. I think both of those are there, if I'm not mistaken. And it was extremely undersupplied. and there was a lot of room for more self-storage there. So I'm not seeing any particular significant issue there other than the rent increases that we've seen since the beginning of COVID, which were astronomical and made self-storage the darling of commercial real estate, have really slowed down and topped off. Speaking of which, the Wall Street Journal touted retail strip centers as America's hottest asset class just back in August. Who would have guessed that would happen after the Amazon apocalypse and the online apocalypse and all that stuff that was supposed to destroy retail? Actually, retail sales have actually grown as a percentage of total sales compared to online since COVID. And so it really does look like, certain retail is doing really well. Open air shopping centers, like I'm trying to think of one we invested in near you. We invested in one in a upscale, actually one or two in upscale suburbs of Chicago with an average income around $100,000. And then we invested in one in Fort Wayne, Indiana as well, not too far from you. And these open air shopping centers, are having a lot of success because of off-price retailers like, let's see, TJ Maxx, Nordstrom Rack, Burlington Coat Factory, Ross, a lot of these off-brand, that sell, overstocks and all that. They're crushing it, and they're grabbing up a lot of the open spaces left by Bed Bath & Beyond, Tuesday Morning, and more. Now, on the other side, of the coin, some of these older, dilapidated retail strip centers, these smaller centers, are not doing as well. And I heard that I don't want to quote a number, but I think I heard there's millions of square feet in these smaller retail strip centers that are prime for conversion to multifamily right now. And I just been reading about that. So I don't know if you've heard about that.
Everyone's talking about the need for more housing and what can we convert? What can we repurpose? So you hear about shopping malls, you hear about office buildings, you hear about strip centers. It's not as easy as people think to just, like you said, with office. I mean, you've got the plumbing stacks, you have window issues, support issues. Sometimes it makes great sense, but a lot of times it just doesn't.
Right. Yeah, absolutely true.
Going back to self-storage, operationally, I'm seeing the same thing with our self-storage. Like it really hasn't suffered at all. It's doing quite well. I think where you run into problems, and this is part of the ripple effect, is we tried to sell one of our self-storage facilities this past year. And the offers came in so much lower than the broker led us to believe we would receive. And a lot of it just has to do with lending and debt service coverage. So I think the real ripple effects are these higher interest rates are really affecting valuations when you go to sell a property.
I agree. And that's, Warren Buffett's got $157 billion in cash on his balance sheet last I checked the other day. And, of course, he's got a couple things. Number one, it's really hard for him to buy as large as he is. Number two, he likes to take cash positions. He doesn't want to use a bunch of debt. Number three, he's getting paid so well on that cash now at a 5% or so interest rate that it's a little less painful, I guess, to keep cash on his balance sheet. But I know that one of the operators we work with, they go in, they buy mom and pop owned and operated self-storage and mobile home parks. They'll buy them quickly for cash, and then they'll upgrade them and they'll increase the income, and then they'll go out and they'll get, let's say, 45% or 50% debt on these, which honestly gives a lot of capital back to redeploy into other assets. And it's a really good play. If you have cash available right now and you can buy for cash, or if you can get owner financing on mom and pop facilities, that's a good play right now.
Yeah, those are two great strategies to take advantage of the market right now. So if you have cash, that's a great strategy. You have lots of cash, or owner financing. I know mobile home parks are one of the assets that you really like. How are they faring in the economy right now?
Mobile home parks are doing really, really well. They actually did not have any downward blip that we heard or saw in the great financial crisis. And that's, 14, 15 years ago now, but they just remain steady. And, it's the only asset type we know of that has a decreasing supply and an increasing demand every year. There really is an affordable housing crisis, as we know. And, most apartments and houses these days are built to, satisfy wealthier individuals. And it's making it very, very hard for people. And, a lot of people they don't want to share a wall with a neighbor. They don't want to have to walk up flights of steps, and they would love to have a yard, or a way to, to have a deck. And so mobile homes really provide a lot of that. They're built so much nicer than they were 20 years ago when I did a couple myself early in my investing career. And these mobile home parks are that just typically lease dirt to people who are buying their own mobile homes. I mean, they're going very, very well. And I have not seen any downward blip in them at all, other than the bad press some of them received for having mean owners who actually raised their rates up to market levels. And by the way, I do think it is terrible if somebody took over a mobile home park and doubled the rent overnight. That would be horrible and egregious. And some of them have gotten in trouble, but they've given other people a bad name who weren't doing things like that. And that's the only thing I've seen bad of. I think the Biden administration has actually provided affordable housing incentives. And so we'll see if that results in the construction of new mobile home parks. Haven't seen any yet. I've heard there were some that, could be on the horizon.
Yeah, mobile home parks are one of the greatest form of affordable housing. It really is a fantastic way to make home having a roof over your head affordable and actually pretty nice. I mean, some of these are really nice properties. Let's kind of wrap it up and put a bow on it. Any final thoughts on kind of the distress, the reports of distress? I mean, what is your real outlook for 2024 into 2025?
Well, like you said, I don't think it'll be easy. I don't think it'll be a cakewalk to walk in and grab these distressed assets in any of these asset types, except maybe office. And I don't know who would want to right now, or who would have that kind of risk tolerance. It looks like from, what we talked about earlier, that, interest rates might have reached their peak for a while. I saw a graph, and I don't have it in front of me, but it showed that interest rates, the climb in interest rates in the mid to late 70s were almost identical. And I mean, hauntingly identical. It almost made you wonder if somebody made up this graph, but this was from a reputable source. It was hauntingly identical to where we are right now. And then what happened, of course, right now, we're only here because we can't see the future. We can only see in a rearview mirror, not a windshield, right? As Buffett says. But in this graph, then if you look past that certain year, and I don't remember the year in the late 70s, it took a quick drop, which a lot of us are expecting right now, and then a massive surge up to like 20%, which, it peaked, I believe, Paul Volcker, December 1980, right after Reagan got elected president, interest rates spiked up to like 20%. And I don't know if that'll happen, but let's face it, there's a lot of cash that's been printed. And it seems to a lot of people that this holding this inflation in check was a temporary, thing. Maybe interest rates will spike again in a couple of years. I don't know. The only thing I know that is that those who use a crystal ball are destined to eat glass.
Most people would be shocked to think, 20% interest rates, that could never happen. Well, it has happened, and there's just as likely a chance that it could happen again. I mean, when you look at how fast interest rates have risen over the past year and a half, no one expected them to double practically overnight. So you're right. No one has that crystal ball. And we can only kind of take the wisdom of the masses and kind of look at that and see, okay, well, what are most people thinking? But I don't know. I don't think most people really thought interest rates would rise as fast as they did.
Yeah. Yeah, I agree. I don't think anybody did. I did talk. I only know one famous person other than you, and his name's Dave Stevens. He was a pretty well-known figure. He was he was high up at Wells Fargo. He was senior VP at Freddie Mac. He was the head of HUD under Obama. And he was then head of the Mortgage Bankers Association for almost a decade after Obama. He's retired now, and I run into him every now and then. I talked to him 2 days ago because he lives nearby here. But he told me before this all happened, he said, this guy, he was talking about Jerome Powell. I don't think he likes him that well, but I'm not sure of that. But he said, this guy will stop at nothing to quench inflation. He will walk in the footsteps of Paul Volcker if he needs to. And you know what? That's pretty much what happened the next 6 or 8 months after he told me that.
Yeah, it was a relentless fight against inflation, which seems to be taming now, but we'll see. Paul, what's your favorite hack or app? What do you use every day that you just can't get by without?
My favorite app is Voxer. Are you familiar with Voxer?
Yeah, I have that app. Yes.
Yeah, Voxer, Voxer. It allows me to quickly, it feels to me like emails are like carrier pigeons compared to using this, because like right before we had this show, I was able to get on there and quickly give several instructions to different people in our company. And I was able to do it just by pushing a button. Well, it's like a walkie-talkie. So I'm just going to leave one right now. Hey, Holly, I found out that they're only going to be until 2:30 Friday. So Doug will need to be there by 2:30 Friday. Okay, so I didn't have to call Holly. I didn't have to get in a chit-chat conversation. I didn't have to open email. I just said that, and I just communicated everything I need to tell her. And now she'll Voxer me back with another walkie-talkie back at me. So I highly recommend Voxer. It's very efficient.
Voxer. Voxer. Great. That's a great one. Paul, how would people find out more about you or get a hold of you?
They could follow me on Twitter at Paul Moore Invest, or they can come to my website. It's Wellings Capital. That's WELLINGS, wellingscapital.com. And if they want to get some free special reports and an actual introduction to how to get involved in commercial real estate, they can go to wellingscapital.com/resources.
And you're also a writer on BiggerPockets. Do you have like a newsletter? Do you have a newsletter list that people can get on?
If they come to Wellings Capital and they sign up for anything like that resources page, for example, they can get on our email list from there. We don't bomb our email list. We try to keep it valuable and we try to space it out. So we'd love to have you join our list if you want to read more about what we're up to.
I can vouch for that. I'm on your list. A really good value that you put out. There's no sales pitchy, invest now kind of stuff, but the really good stuff. And Paul, I appreciate you coming on the show and talking about this distress and is commercial real estate going to crash? There's a lot of answers to that. There's a lot of asset classes, a lot of nuances and variables. Don't listen to anyone who says, oh yeah, real estate is heading for a crash, because they don't know what they're talking about. There's all kinds of real estate. And I appreciate you coming here and clearing that up and sharing all the value. It's been a real pleasure.
It's been great, Brian. Look forward to seeing you on here again.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com.